look at that when confronted by this committee, because I strenuously believe that you should have some authority and responsibility in that effort. Mr. Chairman, I yield back my time.
The gentleman from California, Mr. Sherman, is now recognized for 5 minutes.
Mr. Chairman, Chair Gensler, I am very pleased with your attitude and your performance, but my views are my own. I'd like to speak for the gentleman from Texas, but he hasn't authorized me to do so. I won't. The chair of the committee says that we ought to have absolute clarity in this issue, and I agree with him. And we can achieve that if the chair will work with me on legislation to say that all intangible investment assets, including all crypto, are securities. That way it would be very clear that investors in crypto get the same protection as investors in stock, bonds, and other intangible assets acquired for an investment purpose. The definition of accredited investor that we have now relates to the wealth of the investor or their income, which may have nothing to do with their sophistication and knowledge. And I look forward to working with others on this committee to have a definition of accredited that discards the idea of wealth and looks instead at knowledge, but also specifies that if you're going to participate in that kind of private placement, you don't put more than 5 or 10% of your assets in any one basket. The definition of an accredited investor we have now is based on wealth levels set in the 1980s, which means they're completely out of date and probably shouldn't be used at all. Mr. Chairman, you said to the Banking Committee back a couple years ago, to the extent there are securities on these trading platforms, under our laws, they have to register with the Commission. So assuming that a particular crypto token is a security, if that's true, is an exchange where that security is traded a securities exchange?
Under the laws, if you meet the definition of an exchange and you have securities on that exchange, yes, you have to come in and comply and register and protect the investing public.
Well, I heard you earlier say that no field in finance is so rampant with non-compliance. If there are those who are not complying with our securities laws, please shut them down as quickly as you possibly can. And I point out that the most famous crypto exchange was FTX. It is now, of course, the most infamous exchange. Congress expanded from 500 all the way up to 2,000 the number of entities that can be beneficial owners and still have the company thought of as a private company. I mean, that's a lot, 2,000 owners. But we've got a huge loophole here where you could have dozens or hundreds of beneficial ownership entities counted as only one if they list the stock in street name. Do you have the authority, and will you move toward a definition of 2,000 that reflects 2,000?
I think you raise a good point, and I've asked staff for recommendations for the Commission's consideration, really to ensure that Congress's will about these numbers, the 2,000 number you reference in the Jobs Act, it really means 2,000, and how to look at, as you say, street name ownership that a broker might hold for hundreds of thousands.
I think you'll find companies calling themselves private that have many, many thousands of beneficial owners, and that's not what the securities law calls for. Companies, when they file their 10Ks every year, they list their risk factors. One risk factor that's increasingly important is the risk of a disruption in the U.S.-China relationship or economic relationship. If investors got explicit information about that, that would protect investors. If companies had to fight for capital by demonstrating their resiliency, their ability to withstand such a breakdown, then our entire country would be more resilient and Taiwan would be more secure. Can you move forward to be more explicit and clear with companies that they need to disclose the risks to the company and hopefully what they're doing to ameliorate that risk of a possible breakdown in the U.S.-China relationship.
Under current rules, companies need to disclose material risk, and if they have operations and there's material risk related to any geopolitical area, not just the one you mentioned, they're obliged to disclose that.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And, Mr. Chairman, it's good to see you again.
It's good to see you. If I can call you Mr. Chair as well.
Absolutely. And as I always like to remind my friends here, we spent a great deal of quality time together at your previous posting at the CFTC when I was chairman of the committee. That said, I'd like to begin by focusing on a proposed rule pertaining to security-based swaps. There's a consensus from market participants that the SEC's proposed rule to publicly disseminate large security-based swap positions would deeply harm liquidity, particularly in the credit market. And I'll note standing up a large position reporting regime for confidential regulatory purposes is sensible. As you know, for example, CFTC has a large position reporting regime for futures, but that information is anonymous and aggregated. In November, I and my Democrat colleagues and Republican colleagues sent a letter from the members of the committee regarding this proposal. We specifically asked that you support an approach that would require confidential reporting, noting the potential harm of putting sensitive position information out on the market. Chairman Gensler, have you carefully considered this bipartisan feedback, and will the SEC amend the proposal to reflect this?
I recall your thoughtful letter and the approach, and we're taking that into consideration. I think the part of the motivation, as I understood it, that Congress put this in the act that you helped write was not only for the official sector to have some information, the confidential information, but also then some of that information to be also in the public domain, and that's what we're sorting through, but your letter is helpful.
I look forward to your response because I think the issues that have been raised are very legitimate. As chairman, as the chairman also discussed, the volume and breadth of SEC rulemaking is of significant concern to me. The implication of many of the proposed rules are massive and often affect the same or interconnected financial products and market sectors. The adverse consequences in one sector can bleed over into another, causing lasting economic harm. I'd like to reflect on my time as chairman of the Ag Committee during the implementation process of Title VII of Dodd-Frank. The CFTC's rulemaking process seemed to be rushed and chaotic, which led to proposed rules that were poorly vetted. As a result, the CFTC routinely resorted to last-minute staff guidance and no action letters that were needed to modify new rules that simply weren't always workable. This patchwork approach circumvented the standard rulemaking process and lacked many real cost-benefit analysis. At this time, many of the proposed rules were required by Dodd-Frank. They were at that time. The same cannot be said today. Even still, the SEC is following the same path, some would say flawed path. The proposed rules have a major impact on every asset class under the SEC's jurisdiction, with serious consequences for public companies, investors, retirees. I recommend the SEC take great care to analyze and carefully consider the impact of draft rules. This way you can avoid the rush to fix all of the unintended problems that were created. Thought to consider, Mr. Chairman, as we work through this process together.
Yeah, I agree. I think the input from the public, we put these proposals together carefully, but we so benefit from the public comment. We benefit from hearings like this as well, and the letters that you send us to sort through. It generally takes over a year before we finalize something, and we take these meetings with market participants seriously and consider their thoughts.
I would just note, Mr. Chairman, you've issued twice as many rule proposals in your first 2 years as the SEC chairman, 53, as chairmans Mary Jo White, 23, did, or Jay Clayton, 26, in their first 2 years. while providing 21% less time for public comments. I get the impression from personnel across the SEC that there are concerns about the high volume and the fast pace of this rulemaking. Let's try and get it right, not get it done in a hurry. With that, I yield back, Mr. Chairman.
The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you for your good work, Chairman Gensler. I appreciate the energy and the talents that you've put to work on behalf of investors. My friends on the other side of the aisle seem to be bemoaning a lack of regulatory clarity, and then in the same breath, they criticize the SEC's rulemaking efforts, which arguably would provide that clarity that they desire. Chair Gensler, in your testimony today, you mentioned that there have been over 130 enforcement actions brought by the SEC against crypto firms that have either engaged in marketing securities without providing the necessary disclosures or failed to submit audited financials or investor protections that would allow investors to actually make a meaningful and informed decision regarding the crypto products or the underlying business. Chair Gensler, based on current law, of those 130 cases, those 130 enforcement actions, how many have you won? How many has the SEC prevailed on?
Many of them are settlements, but those that we've taken to court, we've won on the Howey analyses, these token issues, 6 or 8 times. We've won on other matters in front of the courts as well. So we've been quite successful throughout.
Okay. Am I correct in asserting that in each of those cases went through a regulatory or legal process and or maybe even judicial appeal, and that actually there are decisions, written decisions on each of those cases, either by an administrator or by a court of law
just having a little watch party.
that do provide explicit guidance based on current law to other crypto and stable coin firms to provide clarity and that actually lay out some rules of the road that should, you would think, guide other crypto firms in their actions.
You raise a very good point. Every one of them is a vote of a 5-member commission, sometimes run by Jay Clayton, sometimes I'm honored to chair, but always a 5-member commission and always with a written public document, an order, or a charging document.
And there's also a joint statement on crypto asset risk to the banking organizations. That's January 3rd, 2023, which lists 8 key risks associated with crypto assets that banks should be aware of. So there's a fair amount of guidance out there and clarity. It's just not the clarity that the crypto industry wants.
Absolutely. We've also been clear and we've been public as a 5-member commission as with regard to the custody of crypto assets, about the exchange definition in crypto assets. We put some of this also out to public comment, but I agree with you. It's not a matter of lack of clarity. I think this is a field that, in the main, has built up around non-compliance, and that's their business model. And they have chosen, even though it's not the law, they've chosen to be non-compliant and not provide investors with confidence, protections, and it undermines the $100 trillion capital markets. If there's one field of finance and investors get hurt, then it's going to undermine those small businesses, and everybody else raising money in the capital markets can get hurt by this field of non-compliance.
That's great. One of the things I worry about in this area is that crypto firms offer an amalgam of services that in the traditional banking system and securities area are ring-fenced. So they do a lot of things like they have exchange function, broker-dealer functions, custodial and clearing functions, and lending functions. And we've seen commingling of investor funds. Can you talk about the risks that arise from
Absolutely.
that
So
structure?
We separate these everywhere else. The New York Stock Exchange is not running a hedge fund trading against the people trading on that New York Stock Exchange. And here we have a field that commingles this and trades against their customers and doesn't give the proper disclosures. And we've brought a number of cases, one settled, one a litigated matter with this regard.
Thank you. Mr. Chairman, I yield back.
The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Pro-crypto.
Thank you very much, Mr. Chairman. Speaking of crypto and commingling of funds, while we're on that subject, prior to the collapse of FTX, did you have any concerns with the company or question if they were breaking any securities laws or harming investors?
Very good question.
I think,
since he was
if I might, I
close
have
buddies
had,
with,
since I've been in this job, a
SB,
general concern
SBF.
about the field, and as expressed here today, about the non-compliance of this commingling of these various functions, and that they should come into compliance by separating exchange from broker-dealer, from what you might call a hedge fund function and other functions.
So with those concerns, did you direct your staff to look into FTX?
I want to stay at a little bit higher level, but I directed the staff to look into the crypto intermediaries.
He's squirming.
And a wide range of crypto intermediaries. Yes, sir.
Okay, so what did they find?
Well, we filed an action late last year, a number of actions, which are public actions with regard to Sam Bankman-Fried and FTX.
Late last year.
That are on our
early.
website. But what we found in those actions, as they show, is we allege a number of violations of the securities laws.
Yeah, when did you think FTX was problematic? At what point?
Well, again, we filed these actions in December, and I think we've
FTX
filed
happened
follow-up actions in
way before
January
that.
because it takes time to develop an investigative file, and we follow the facts and the law where they come.
Pretty much wasn't doing the
But
job.
I've given speeches, and I've been clear with many members of this industry that right now they need to come into compliance. We have one goal, is to bring them into compliance and to stop commingling all these functions, stop using customer funds as if they're their own. It's like somebody who's got their hand in the cash register because they say, I want to take some money out of the cash register for the weekend. I'll put it back later. And that's just not proper.
How long after you met with FTX and investigated, did you notify the public and investors that?
Yeah.
Again,
exactly.
as we've chatted earlier today, we protect anything we do in our examination function, our investigative
able to
function.
answer.
We protect
He's
that
been meeting with Sam
information and hold it
Bankman-Fried
confidential
way before December.
because it's important for the integrity of any investigation, but also for people's privacy. And often we find that we close investigations without bringing action. So there's a time-tested reason that you, of course, would want us to keep things confidential. So we only make them public when and if we either settle or bring charges.
So he has no answer, pretty much.
Sad to hear that. The Inspector General found that your SEC is facing the highest attrition rate in 10 years. You know, how's the attrition rate affecting
Really good
your
stuff. It was so fun.
agency's ability to regulate digital assets?
No, it's a very dedicated workforce. We've moved up to about 6 or 7% attrition. That's consistent with other financial regulators across the U.S. government. I'm really pleased to say that last week the Partnership for Public Service, we went up in the overall rankings. We're now in employee surveys. These are employee surveys done by outsiders. I think we're now third out of 27 mid-sized agencies. But in terms of digital assets, we could certainly use more resources. I mean, it is definitely, there are more things to look at and investigate than we have people on the staff to do.
Thank you. Thank you, Mr. Chairman. I yield back.
My cousin messaged me. I
gentleman
should be
from
at the
Missouri,
hearing.
Mr.
I will
Cleaver,
be
is
at
now
the. I want to be
recognized
at
for
the
5
hearing. I
minutes.
wish I was at
Mr.
the
Chairman.
hearing.
Mr. Chairman, thank you for your April letter, which I interpret to be a gentle reminder to Congress that we needed to raise the debt ceiling. And I appreciate the fact that you clearly understand and recognize the importance of this. I mean, we've raised the debt ceiling 78 separate times since 1968, and both parties, 49 times under Republicans and 29 times under Democrats. It is something we have to do. My first question is, do you think that the mere suggestion that we're not going to deal with the debt ceiling create a problem for us economically? I mean, one of your responsibilities is maintain some level of order in the markets. So what do you think, just a mere suggestion, just a mere threat, what does that do?
It puts a dose of uncertainty into markets, but it becomes particularly problematic the closer one might get to whatever deadline that is. And that's not our jurisdiction, that's others. But, and then if we were to go over said X date, it would really undermine.
If the volume's a little weird,
it would be
let
one
me know.
heck of
I
a
can
mess in
adjust it over
capital
here.
markets, that's for
If
sure.
it's too loud, I
but
can
it would
adjust
undermine the base of our capital
the desktop
markets, U.S.
audio.
Treasuries, or the risk-free part of our capital markets that everything else is built on top of that.
I was here in 2011 when there was a stalemate. We're not going to do anything, and so we ended up, of course, averting the cataclysm, but we still did damage to the economy because the gamesmanship caused us not to address this very serious problem. I guess we have failed once, at least, maybe more. You may be to address our obligations. 1812, we didn't have the resources for a period of time, but since then we've met our obligations, and I'm really maybe obsessed with what could happen if we don't, and it's troublesome to me. I don't think you're probably old enough to remember a movie that came out in 1974 called Blazing Saddles.
Love that movie.
It's one of my favorite movies. Should have won the Academy Award. But you may remember the scene. Gene Wilder's just brilliant, but Cleavon Little played the role of a guy named Bart. And at one point in the movie, he is surrounded by people who are ready to lynch him. He takes out his gun and puts it to his own head. And he said, "Get back or I'll shoot." You're probably hesitant to want to say this. Isn't that what Congress is doing right now with the debt ceiling?
Well,
When it comes
being
to debt
old
ceiling,
enough
I
to
think
have
so,
seen
yeah.
the movie, I think I learned enough to say it's between Congress and other parts of the administration, the Treasury Department, and the White House. I can just speak to the capital markets piece. On the capital markets piece, we've already seen some small bits. There's certain money market funds and other funds that are being careful about which short-term Treasury bills they buy. But if we were to get close to that X date, your proverbial visual that you just did from the movie from 1974, it is likely that we would start to see fraying, less liquidity in the Treasury markets, which ultimately means higher costs to the taxpayers coming into that. And then, if we were to go over that default cliff, it would be, of course, unprecedented, but it'd be one heck of a mess in capital markets. It would hurt the equity markets. It would hurt the rest of the fixed income markets. And it would ripple into the banking system as well, not to mention all the money market funds.
Thank you, Mr. Chairman. I yield back, Mr. Chairman.
Well, I like my colleague. I think we need to exchange movie lists. A lot of bipartisanship, that's true. So with that, we'll go to the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr.
All
Chairman.
right, Missouri in the building.
Welcome, Chair Gensler. We certainly appreciate you being here today. And when I was talking to some friends of mine yesterday about your appearance, they said, the APA director. And we both chuckled about that, but it makes the point that it seems as though your agency has taken on a different mission, that you seem to be pushing an ESG agenda, which is, in my mind, something that's not in the best interest or under your purview of the SEC. So I'll let my other colleagues get into that a little deeper, but I want to put something on record with regards to that.
I'll shut up now.
My first question deals with mortgage insurance-linked notes. According to the National Association of Realtors, the average first-time home buyer's down payment is 6%. In an environment of elevated interest rates and home prices, private mortgage insurance can make the difference between a family becoming homeowners or waiting years on the sidelines to amass a 20% down payment. At the same time, private mortgage insurance protects taxpayers by standing in front of credit losses at the GSEs in the event a borrower defaults on low down payment loans. Like other insurers, private mortgage insurers must manage capital positions and risk exposures on an ongoing basis. Mortgage insurers are in fact encouraged by state regulators and FHFA to manage that risk through purchase of traditional reinsurance and through capital market structures such as mortgage insurance-linked notes. However, SEC's recent reproposed conflicts of interest rule may unintentionally restrict the ability of private mortgage insurers to utilize mortgage insurance-linked notes as a risk management tool because the rule does not define the term synthetic asset-backed securitization. Chair Gensler, as the SEC continues to work on the conflict of interest rule, will you ensure that the final regulation does not cause unintended harm to the residential mortgage market by limiting the ability of mortgage insurers to utilize critical capital and risk management tools like mortgage insurance-linked notes?
This rule proposal is one of those, if I can call it, leftover mandates that Congress had put in place 13 years ago now in Dodd-Frank. So we put out a proposal to do that which Congress said, that if somebody was doing asset securitizations, they couldn't effectively trade against their investor clients, which is something Congress saw happening back in the 2008 crisis. And so we're committed to do that within the law, and obviously to take in the comments that you're talking about and sort through this.
Okay. Obviously, there's some concerns about that, and hope that you'll be able to address those. Okay? Very good. Well, with regards to the banking crisis that we've had recently, I think it's an instructive moment from the standpoint of things that we maybe were not thinking about before. We saw with this crisis where somebody got on social media and within less than 2 days had $42 billion run off the books as a result of a social media tweet and the follow-ups from that. That got me to thinking and concerned, and in fact, this morning, the CEO for Charles Schwab, Paul Bettinger, voiced the same concern that I've been talking about for the last several days, which is about short selling. It would seem to me that if we have a situation where we have a lot of banks that are not very liquid right now, that there's some concerns about, that somebody could play some funny games with our not just the banking industry, but our economy as a whole. It could be somebody trying to make money. It could be a foreign actor who wants to do something different to our economy.
Really good question, actually.
So the question becomes, if you want to... So I guess what my question really is two parts. Number one, do you have the ability to stop a short sell problem that arises within the banking industry, for instance, based on its threat to the entire industry?
Both buying a security, going long, it's called, and shorting a security are important parts of our capital markets and important parts of and are legal. To go both long and to go short, it's a way to express and help capital markets work. And so we facilitate that. What we guard against is people trading on material non-public information, and we guard against people doing manipulative acts in the market. So it's really...
well, my question is very simple. Do you have the authority to keep this abuse from happening, this manipulation from happening for the wrong reasons? Understand that it's part of the market structure. It's part of market investing. But if people are doing this to try and cause a run on the banks, to undermine our economy, undermine the industry for their own profit, or as a foreign actor to do something, do you have the ability to stop that? That's my question.
I don't think he does.
We most definitely have the authority and the ability to go after fraud and against manipulation in capital markets.
My question is, do you have the
taken.
authority to have a across-the-board ban on short selling so you can stop this from happening by people continuing to tweet?
I don't believe that Congress has given us that authority, sir. We've given authority to deal with individual acts of manipulation and chasing after fraud.
Gentleman's time is expired.
Okay, thank you very much.
Banning
The gentleman from Connecticut, Mr. Himes, recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Gensler. I don't have blazing saddles today, but I've got Lionel Trilling. Lionel Trilling was a American critic, an intellectual who, in a book in 1950 called The Liberal Imagination, said that American conservatism is not so much about ideas. It is, quote, a series of irritable mental gestures which seek to resemble ideas. That was true in 1950. It's certainly true here today. And to illustrate that, the head-spinning irony of where you're sitting right now is that less than 3 weeks ago, the Federal Reserve, the FDIC, and the Treasury were sitting in precisely those seats in a hearing about the crumbling of Silicon Valley Bank. And to hear the majority at the time, it was all their fault. They had done too little and they'd done it too slowly. Something you might remember as you get accused of doing too much too quickly. I promise you that when something goes wrong under your jurisdiction, you'll be sitting back in that seat having done too little too slowly. Now, never mind that Silicon Valley had one banker on their board of directors and 0 bankers on their risk management committee. Never mind that the vast majority of their deposits were unguaranteed. Never mind any of that stuff. It was their fault. And I promise you, when something goes wrong under your jurisdiction, you will have done too little too slowly. You've been accused of not being here. The Republicans have been now in the majority for 100 days. You were here on day 100. Did you receive an invitation from the Republican majority prior to the invitation that brought you here today?
We worked with the chair to come when he wanted me to be here.
Have you said no to a majority invitation to testify?
We'll work, and whenever the chair wants me
where
here,
you're going
I'll
with
be
this
here.
question.
Okay, all right. Having gotten that off my chest, I do have a serious question. I've long been concerned by the fact that an awful lot of our capital markets are migrating to private markets. You mentioned it in your testimony. You point out that the amount of liquidity in the private markets now exceed actually the banking system in size. If you look at public versus private market offerings since 2009.
Probably a really good thing to look
Registered
up and
offerings are more or less flat since
Really
2010 anyway, and exempt offerings are really skyrocketing. The challenge there, of course, is that individual retail investors, by and large, can't invest in private offerings. I worry that profitability and good deals will migrate to those private offerings that accredited investors and institutional investors, that's a term of art for people with substantial amounts of money, can invest in, and retail investors will be left with an increasingly small set of opportunities to invest in the American capital markets. So with my 2 minutes remaining, Mr. Chair, I think it's fair to consider the possibility that the regulatory structure, which I have long supported around public offerings, creates some arbitrage for issuers versus the exempt market. So I just want to give you 2 minutes to reflect both on the proposals that you've made with respect to market structure, but also overall, big picture, are there things that we can be doing along the lines of the Jobs Act or anything else that would hopefully reduce some of this arbitrage between the public and private equity markets?
Let me start by, I think that the American economy is benefited both by vibrant, robust public markets and private capital markets. My dad never had to tap the private capital markets of like today, but he ran a small business with 30 or 40 employees, and he didn't tap the public markets.
This was in the past, though. It's not
I was at Goldman Sachs for many years before it was a public company, and I was a big company that tapped only private markets. So I think both have a role to play. In terms of our regulatory agenda, what we're trying to bring is greater efficiency and competition in the asset management of private capital, this $25 trillion of assets under management by hedge funds and private equity and the like, and through greater transparency of their fees, their performance, and their side letters where they might be, having different deals. And this is really going to help the retirees in all of your states, because most of your states are invested in private equity and in hedge funds as the limited partners. It helps the state treasurers, it helps the endowments, it helps the people behind that if we can bring greater competition in a field that probably has, at just 2%, it would be $500 billion a year in revenues to the asset managers. This is what I meant earlier. It's important that our capital markets work for investors and issuers, not the middle, maybe.
Time's expired. Thank you, Mr. Chair.
We'll now go to the gentleman from Michigan, Mr. Huizinga, for 5 minutes.
Thank you, Mr. Chair, and I'm glad to see you here, Chair Gensler. And I do want to congratulate you on finally appointing a permanent Inspector General yesterday. A little late coming, in my opinion, but in late February, I'm going to jump right in. In late February, Chairman McHenry, Senator Scott, and I sent you a request of documents and information on your climate disclosure rule. The fact is, other than a couple of emails that were private, you have produced only publicly available documents in response to that request. And I'm going to highlight a couple of those. You sent us a copy of the public comment file on the rule. You sent us a copy of the rule itself, twice. You sent a copy of your testimony the last time you appeared before this committee. You sent us a copy of your public calendar. You sent us copies of public speeches, testimony, and press releases from you and your fellow commissioners. You sent us a copy of a public FSOC report from 2021. And the most interesting and frankly dumbest example of this that we received to date is a copy of a letter that myself and Chairman McHenry sent you congratulating you as being confirmed as chair in 2021. I have that one in my file already. Wow. So frankly, it's insufficient and frankly unacceptable what has been going on.
Yes, it is.
I think it's an embarrassment to you and to your team that you sent me a copy of the letter I sent you and then tried to call that responsive. That doesn't really make a whole lot of sense. And further, your response letter to the chairman and myself, the SEC staff admitted that the proposed rule, quote, could increase costs, quote, close quote, related to energy prices under certain circumstances, but you provided no analysis, the actual information that we were looking for, not my letter to you congratulating you as becoming chair. We wanted the analysis on how the commission determined that. Did the SEC conduct an analysis of how this new climate disclosure regime could change energy prices before publishing the proposal?
Under the law, focus on the costs and benefits.
Did you produce an analysis? Did you conduct an analysis?
The analysis that we put out is in the proposal we put out last year about the economics with regard to issuing companies.
You did do an analysis, all right? Because it looks like it may have relied mostly on public comments to form your cost-benefit analysis.
I just want to make sure for the record, I didn't.
Let's go,
we
Michigan.
did an analysis with regard to the
He's
cost.
been doing a lot of squirming today.
It's technically the efficiency, competition, and capital formation analysis that we put, and it's out there in the public domain, and we've gotten feedback on that. We're not a climate regulator.
So, well, amen to that.
I mean,
we understand that.
on that, sir.
So, did you rely on any internal economic data or assessment to inform your cost-benefit analysis? In other words, did you, the SEC, perform any of that cost-benefit analysis internally?
So the SEC looked at, I think, over 6,000 public registration
So that's a yes?
statements. Yes, there's a lot of analysis, and that is summarized and put out to public comment.
All right, and I would like to see those documents provided immediately. You're willing to do that then?
I'm a firm believer in congressional oversight. I know that I'm not.
Okay, well, that was previously requested, and you sent me a copy of the letter that I sent to you congratulating you. So, sounds like we now have an understanding that you're going to actually send us your analysis.
So, I know that this.
Yes or no?
Well, I know that our staffs are working with.
We have a minute. Yes or no?
And
Wow.
I believe in congressional oversight, and I know
Okay,
staff's
all right,
working.
moving on. I'm taking that as a no. So
Yeah,
the
exactly.
climate disclosure
So
request,
good.
you like that. You responded to our FTX request solely with publicly available documents. To date, 213 pages of those publicly available documents have produced. And guess what? You didn't give us anything surrounding the charges filed against Sam Bankman-Fried. On April 12, Chair McHenry and I sent you a follow-up letter.
That's freaking
and
crazy.
we're led to believe that the staff recommendation memo presented to the commission for a vote on charges against Sam Bankman-Fried exists. Is that true? Is there a memo from the staff recommending to the commission
No,
the charges that Sam Bankman-Fried was ultimately charged with?
Under standard practice, our commission receives action memos from the staff on every.
So it does exist.
We work on.
So it does exist.
Doesn't
Okay, well,
answer.
you
He
haven't
doesn't
sent
answer.
that to us. Your staff has frankly told us that it exists, yet you have not sent it.
When we conduct an investigation, we are obliged to keep investigative matters confidential.
So don't hold on a second. Don't hide
Look at
behind the
his hands
DOJ
shaking.
because
It's
then
like
it sounds
when he
like I need
answers,
to
his
send
hands are
letters
like,
to the DOJ and not to the SEC about the SEC charges. So we'll be following up with this after this. My time has expired.
Response to our
Good
questions would be
times.
appropriate. We'll go to Mrs. Beatty of Ohio for 5 minutes.
Thank you, Mr. Chairman. Thank you, Ranking Member. And thank you to our witness today, Mr. Gensler. Thank you for also responding to us and taking the time to talk to me about the SEC and meet with our team and being here today. Kind of staying in this same questioning with the climate rule. As you know, and many may know, I'm a former small business owner myself, so I think I know as well, if not better, than most of the unique challenges that small businesses might have, as well as maybe family farms. With that in mind, I want to ask about the Commission's proposed climate disclosure rule. We've heard many critics, people on the other side of the aisle have framed this rule on its emissions disclosure, especially Scope 3 emissions requirements, as being burdensome for small businesses and family farms. I've been doing a lot of reading, research, articles on this, so I want to give you a minute or so to chat with us about, is this rule that burdensome to small businesses, or are there actually ways that they've been protected?
So our proposal and our authorities are about
The one
public
thing about
companies,
watching these
and
things
that's
is really
what it
important
speaks to.
because
And
it
really,
does
it's just
cause
about
the
public
market to move.
companies.
And I know the move
We
is
do
up.
not
The market
place
is moving
through
up.
this proposal, and nor do
these questionings are pretty good.
we intend to have any obligations on non-public companies. You know, there's small businesses, there's agriculture interests that you might be referencing. Companies currently are making, hundreds and hundreds of companies are making
While this is going,
disclosures about greenhouse gas emissions. And some of those are, as you mentioned, about their supply chain or so-called Scope 3.
That's Ethereum.
And even in our proposal,
Going
we
up
recognized and we said
30,205.
our obligation is, the obligation is only on the public company. They
197,
can make
pretty much
estimates
200.
if there's something that they are talking to their shareholders about.
Let's get back to the
But we got a lot of feedback, we got a lot of comments on this issue, and we're taking that into consideration. And as we do on all our rules, we'll consider making adjustments if appropriate.
Okay, thank you. Let me try to get another question in here. Certainly, as you know, investor protection is a key part of your mission. And I want to take a moment to highlight some of the investors in my home state of Ohio, like teachers and firefighters, police and other public servants, saving for retirement through their state public pension system. These public servants saving for retirement are a part of the constituency the SEC is tasked with protecting through its investor protection mission. last month, and we've heard, or it's been referenced many times about our SVB hearing, I expressed a concern then about the Ohio State Teachers Retirement System, how it suffered a big loss with some $27 million invested in SVP. What actions has the SEC taken under your leadership to protect these workers, their retirement savings, or what can I go back and tell my constituents?
Well, I think really most of our agenda, whether it's our enforcement that we do, ensuring that people follow the law, or our rulemaking, helps protect those retirees. But I would just even go back to an earlier comment. We're really trying to bring greater competition and efficiency in the private funds area, because those retirees are often invested in those private equity and hedge funds. And if we can help through transparency and still greater competition, that could mean lower costs, lower fees to those folks.
Okay. I have about 35 seconds. Is there anything you'd like to share with us if I yield my last 30 seconds to you?
Why would you do that?
If I could just note something about you mentioned your hearing about the recent events in the markets, and I would note there were 3 banks that failed in those handful of days, those 4 or 5 days. And 2 of those banks, the first and the third that failed,
it seems like another bank is actually going to fail as well.
Were engaged in the crypto business. I mean, some would say they were, crypto banks. And the third, the biggest, Silicon Valley Bank, actually, when it failed, you saw this country's, the world's second leading stable coin, had $3 billion involved there, DPEG. So it's interesting just how this was all had some crypto narrative as well.
And my time is up. Thank you, Mr. Chairman.
The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Chair Gensler, you've publicly stated that, and I quote, "Our markets are the finest in the world," and that, quote, "retail investors have greater access to markets than at any time in the past." Yet, despite these statements, which I wholeheartedly agree with, you still released 4 proposals last December: order competition, regulation best X, tick size, rules 605, that completely upend those markets and remake them from top to bottom. There is a strong possibility that these 4 proposals could make equity markets more costly, less efficient, and overall worse for retail investors. Throughout these proposals, the Commission admits over 100 times that it is uncertain of the impacts of the proposal and that it is unable to quantify or, quote, estimate the economic effects of the proposals.
Interesting.
This uncertainty means that these proposals will likely make markets worse for retail investors. You may be willing to risk that, but members of Congress who represent these retail investors, as well as American businesses seeking to raise capital in our equity markets, are not, sir.
Wow.
If the SEC's client truly is the American public, as you've said many times before, then I would urge you to reconsider these proposals before putting millions of Americans' hard-earned savings at risk.
Yeah, he's just going proposal crazy.
You said repeatedly, let me change topics here, that the duty of best execution is too important for only FINRA to have a best execution rule, and that the SEC should have one as well. I'd like a yes or no answer here, sir. Are you aware that there is a process under existing rules for the SEC to amend or change FINRA's rules, which would include its current best execution rule? Yes or no?
Yes, I'm aware we have that authority.
Yes or no? Do you believe FINRA is incapable of maintaining and enforcing an adequate best execution rule?
I think this is an important rule that we should have at the Commission level.
Yes or no? Are they
yes or no? Yes or no? Come on, tell them. Yes or no?
Maintaining and enforcing an adequate best execution rule?
Again, I think we should adopt one at our level as well, and we have it in other areas.
All right, reclaim my time. As proposed, it would be duplicative, onerous, and costly for firms to comply with both the SEC and now FINRA's best execution regulations at the same time. Chair Gensler, your proposed rule on open-end fund liquidity would require funds to assume a worst-case scenario of a 10% sell-off on the fund when classifying the liquidity of assets. I have spoken with many asset managers who inform me a 10% run would be a magnitude higher than any that they have seen in recent history. One asset manager informed me that the highest run they have seen going back to the crash of 2008 was 2%. What historical data did you use to justify the 10%?
10%?
And is it appropriate for the SEC to require funds to operate in a scenario that is 5 times worse than historical standards?
This was just to define what is highly liquid, middle liquid, and illiquid. And so it was really a definitional.
What historical data did you use to come up with the 10%?
Again, we lay that out in our
he won't answer.
No, you don't.
Proposals, but I'd be glad to follow up.
Yeah, you don't lay it out at all. Chair Gensler, you have testified before this committee twice that both times I have asked you if you intended to rewrite Regulation Best Interest Reg BI, and you have said no. Is that still the case?
That's still the case. It's not on
Do you
our
remain
unified
committed
agenda.
to supporting the continued implementation of Reg BI?
We look to vigorously enforce it.
Okay. Do you intend to rewrite Regulation Best Interest Reg BI? You've said no in the past.
Oh, I'm sorry. I misunderstood your question. It's not on our unified agenda.
Gary does not know
Chair
how to
Gensler,
answer it.
out of the more than 50 rules proposed under your leadership, none appear to directly address capital formation. If you believe that one or more of these proposals directly addresses this crucial issue, please cite which ones and specifically how that standard is met in 10 seconds.
I think that many of them do because it's about issuers and investors. I would just take private funds. If private fund advisors, the general partners, are taking $500 billion of fees a year, if it
My time's expired.
down,
I'd ask you to respond in writing and be very specific to your mandate of protecting the retail investor, capital formation, and small businesses and IPOs.
Wow, that was great.
Gentleman from
Great,
Illinois,
Wagner.
Mr. Gass,
Mrs.
is now
Wagner.
recognized for 5 minutes.
Thank you, Mr. Chairman. Nice to see you, Mr. Chairman. Do you believe that climate change creates significant financial risks to corporations?
I'm sorry, I didn't hear the word in there.
Do you believe that climate change creates financial risk to corporations?
It's really what investors are basing their investment decisions. And what we found in public input is significant number of investors managing tens of trillions of dollars of assets believe that it's important to their investment decisions. That's the standard we're held to.
Well, let me maybe then sort of add a little color. In 2020, as you know, the CFTC said that climate change poses a major risk to the stability of the U.S. financial system. In 2021, FSOC said that climate change is an emerging threat. And recently, the IPCC said that within the range of possible temperature rises, global economic losses could amount to $23 trillion per year.
Interesting.
Are these numbers material?
They're significant to the economy, but what's material is that investors in public companies are today making decisions based on climate risk disclosures, and we're trying to bring some consistency to that.
Is it your view that clear disclosures would help investors to hedge those risks?
That is certainly what our comment file, that we've had thousands of investors who have said that to us.
Okay. I'm assuming this is a yes. You're familiar with the term information asymmetry?
Yeah, yes, I am very much so.
Okay. There was a report from Nature Climate Change recently that said that real estate in the United States is estimated to be overvalued by $121 to $237 billion due to unpriced flood risk driven by climate change, with low-income households facing the greatest risk of losing home equity, as was the case in the 2007-2008 housing crisis. Can you speak to how your proposed rule would address that informational asymmetry between folks who are aware that they're overpriced and folks who are not?
I mentioned it about Chair Rayburn and President Roosevelt. They were trying to address information asymmetries, that the public didn't have full, fair, and truthful disclosures from companies accurately describing their risk. That's what we're doing here in this proposed climate risk is so that the investing public better understands the risk when they buy or sell a security.
Okay, when I'm done here, I'm going to run to the Science Committee, so you'll forgive me if I dump into the science side here a little bit. There was an article in the Washington Post, I think it was just last week actually, that talked about the effect of climate change in coastal communities in the U.S., found that recent hurricanes Michael and Ian were both made much worse by warming oceans. Federal tide gauge data, this number was shocking. In Louisiana, the sea level is 8 inches higher than it was in 2006 when Hurricane Katrina hit. Just since 2006 is 8 inches higher. NOAA has said that they expect 2 feet of additional sea level rise on the Gulf Coast by 2050. So if you buy a home in Pensacola today, it'll be underwater before the mortgage is paid off. I could go on and on. There's data from First Street that there's more than 400,000 properties,
today's pretty
more
much
than a third in West
day.
Virginia.
There isn't much happening today when it comes to the markets.
Is it logical to assume that
so today is a beautiful day for trade. If you're going along, today is definitely benefiting you.
That risk onto less sophisticated
Let me
players.
get back to this real quick.
Public companies, which is the only thing we oversee is the public companies, manage their risk, and this has become an important risk, and it's a risk that investors want to understand how they're managing it, whether, as you say, they're defraying it or offloading it on others, or they're retaining it inside. And that's really, it's about disclosures of how they're managing that risk, like they manage other risks.
So I asked that question because we know, and the CFTC report actually acknowledged that they said that they have seen that insurers are offloading risk onto Fannie and Freddie disproportionately in flood-prone areas. Given that movement, and given your obligation to protect investors, is it safe to say that your mandate is to protect all investors, not just the sophisticated ones?
It is absolutely correct that it's all investors, whether it's the most sophisticated, the largest, and the smallest, but we're merit neutral, I just want to say. So it's a matter of disclosure-based, disclosing the risk and how those companies are managing those risks.
Well, obviously from my questions, I agree, and you had mentioned $130 trillion of global assets under management that are looking to get into ESG pieces. And as we sit here saying, should we be protecting all investors, or is that just woke? I'm glad to hear you keep pushing this, and I would just urge you, given your mandate at the SEC, to continue to push hard for a strong climate.
The gentleman's time has expired. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Chairman Gensler, I want to discuss Staff Accounting Bulletin 121, which was issued last year by the SEC's Office of Chief Accountant. SAB 121 requires SEC registrants, including banks, to include on their balance sheets crypto assets that are custodied on behalf of their clients. Requiring banks to place custody digital assets on their balance is a shift, as Chairman Powell recently noted, in historical practice, as custody assets have always been treated as off-balance sheet. SAB 121 changed that, and I'm concerned about the consequences because banks have capital, liquidity, and other prudential requirements that non-bank custodians do not have, meaning that banks cannot offer digital asset custody services at scale without significant balance sheet implications. If banks cannot provide digital asset custody services at scale, they simply will not offer those services, which could lead to market participants not having bank-grade custody solutions to pick from and will turn to offshore solutions, like in the Bahamas, diminishing American competitiveness and compromising investor protection. Chairman Gensler, has it occurred to you the irony that at the same time you pursued SAB 121, which has effectively precluded highly regulated banks from offering customers the safety and security of segregated digital asset custody services, not a single one of the 4,500 employees under your supervision at the SEC noticed that FTX was allowed to commingle customer funds, allowed FTX to trade, settle, custody, lend, and borrow digital assets without institutional-grade custody?
I'm actually quite proud of the staff that put out that staff accounting bulletin, because what they said is that public companies, not just banks, but that public companies needed to put on their balance sheet if they had their customer crypto. And it's what we've subsequently found in bankruptcy court, Celsius bankruptcy and others, that in bankruptcy, investors just stand in line.
Well, reclaiming my time, did you or your staff consult with prudential bank regulators? Was there any interagency interaction on SAB 121 before or after this was issued in March of 2022, given the ramifications that this effectively prevents well-regulated banks from providing digital asset custody services?
There was significant dialogue beforehand with accounting professions, the Big Four, and others, because this question kept coming up, but there has been consultation about this with the bank regulators subsequently.
Well, I find it very interesting that nobody at the SEC, under your supervision, noticed that FTX, a one-time $32 billion company, was run on QuickBooks. Private funds rulemaking. You have repeatedly stated that increasing competition in the private fund market is one of the primary objectives of your proposal. But last week, the Committee on Capital Markets Regulation issued a competitive analysis of U.S. private equity fund market. Its key findings: concentration is very low and 4 times lower than the concentration of the public mutual fund industry. The number of fund advisors and funds is steadily growing. The range of investment strategies available to investors is increasing at a significant rate. Barriers to entry are low. Effective management fees have been declining. Performance net of fees and portfolio diversification benefits outmatch that of public markets. Demand from investors is growing. This analysis directly refutes the entire basis of your rulemaking, that there is a lack of competition in private equity. Indeed, your proposal will have the exact opposite effect: reduce competition in U.S. private funds markets, including disadvantaging newer and smaller private equity advisors and decreasing the number of investment opportunities available to investors. When you contend there's a need for greater competition in the private funds market, what specific evidence are you relying on?
He won't give you an answer.
Just looking at this field and what the limited partners came to the SEC and did various filings with us saying they needed greater transparency about fees, about performance, and about the side letters, and particularly the side letters, because the fund managers are cutting special deals. If I might just say on the earlier point on crypto, if these companies had registered, we'd be able to look at their books and records. But when they don't register, the only tools we have is actually investigative.
Well, reclaiming my time and back to private funds, you know, the United States has only 4.4% of the world's population, but 50% of the capital is raised here. And Europe, by contrast, has the same population, but less than 20% of the capital raised here. The difference between us and Europe, and I want to stay the U.S., not Europe, is that we diversify our markets with private capital being a big driver, making credit easier to obtain for all Americans, making investments in tech, in healthcare, biotech, manufacturing, higher paying jobs. So when you analyze proposals to change our capital markets, don't forget to recognize we've got a much better system than Europe. Let's not be Europe.
The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Chair Gensler, for joining us today for this critical hearing. Although I wish it didn't have to be repeated, I know there are some who deny this fact, so I just want to reaffirm that climate change is real. It is here, and let's be very clear that our constituents' investments, whether it's their personal retirement savings or college savings for their children, are at risk. The good news is the SEC's proposed climate disclosure rule would help protect investors by requiring companies to disclose their exposure to climate risk. Although the cheerleaders for big oil want to weaken this rule, the consequences are clear. Without a comprehensive climate disclosure regimen, we will fail working class people throughout our country, and we will fall far behind our global
climate change
partners.
Because
Chair,
I guess it does affect the economy.
You mentioned earlier that during the comment section that there were thousands of investors that commented favorably, correct, on the proposed rule?
That's correct. I think we've gotten 15,000 comments, and on the investor side, it's almost uniformly supportive of mandating climate risk disclosures.
Right, they were overwhelmingly favorable. So for those watching at home, I just want to get into the details to better explain why they were so overwhelmingly favorable. There are 3 categories of greenhouse gas emissions. Scope 1 and 2 emissions result from a company's operations. For example, the pollution from a company vehicle or their use of electricity generated from fossil fuels. And then there are Scope 3 emissions, which are the biggest category, making up on average 70 to 80% of a company's carbon footprint. These are resulting from indirect ops, which include the entire business model, including emissions produced by suppliers and also from consumers using the company's product. Big Oil is fighting to get rid of Scope 3 emissions disclosure from the SEC's proposed rule because in a world without transparency, they can gravely misrepresent their exposure to climate risk and rake in millions of dollars. If oil companies like Chevron reduce their Scope 1 emissions by switching to electric vehicles for transportation, and their Scope 2 emissions by installing solar energy at their headquarters, then they could technically claim to be net zero, even if they continued selling fossil fuels as their core product. Chair Gensler, if you were an investor looking at climate transition risk in your portfolio, do you think that looking at an oil company's Scope 1 and 2 emissions alone would give you an accurate picture of your risk exposure?
Well, in my personal portfolio, I'm only allowed to be in index funds, but in terms of, or broad-based funds, but what we've learned is many of the comments we received from actual investors have said they would like to have better consistency around this greenhouse gas emissions, including some estimate about their supply chain.
Right, the people want to see Scope 3 disclosures. The European Union and other countries around the world are implementing new disclosure rules that include Scope 3 emissions in the next few years. Now, some argue that reporting is too burdensome, but 70% of U.S. companies will be reporting Scope 1, 2, and 3 emissions within the next few years, regardless of what the SEC does. So let me make it plain. This is not the time to backtrack and to weaken regulations. Now is the time for action and to put people over polluters. Thank you, and I yield.
The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. We've seen a troubling, and I'm from Texas, I need to tell you this, so a lot of this conversation doesn't ring well back where I live, but
Here goes Texas.
we've seen a troubling trend with current administration who continues to call for more government regulations and push an anti-growth green agenda. The SEC's climate risk disclosure rule would have major consequences for the businesses across the country, especially smaller entities who lose out on opportunities because they cannot afford the increased compliance costs that come with burdensome regulations like these, and we see this administration continue to put the pressure on small business. An economic analyst of the SEC's climate proposal estimated that compliance associated with these requirements could cost over $100 million for certain companies. This would be detrimental for companies and will stifle innovation and businesses' ability to grow. So what is the SEC's legal authority to enforce these climate-focused regulations, and how does the SEC plan to ensure that its climate disclosure rule does not disproportionately harm smaller entities? I'm a business guy in Texas. I'm a small business, which may lack the resources and expertise to comply with the rules reporting requirements.
Let me take your second question first,
Okay.
all right. Our authorities are just about the public registrants, these 7,000 or 8,000 companies. And we're not placing any obligations on non-public companies, companies that aren't raising money in, like, on the New York Stock Exchange. In terms of the authorities, we're staying right within those authorities I talked about earlier that Rayburn and Roosevelt wrote. It's about describing the business, putting it out there, the full and fair description, including the material risk, and investors today are making decisions based on climate risk disclosure. So it's trying to bring some consistency to that.
Again,
but we are not a
it looks like
climate
there's a lot of
regulator, and we're neutral about that.
So following up on this previous question we talked about, is it clear that your climate proposal will undoubtedly impact private companies who cannot shoulder the increased costs that would come with collecting and providing data obligated by this rule? This is not making our public markets more attractive to companies trying to break into the market. And this rule's unnecessary information requirements will subject companies to public scrutiny, investor pressure, and increased regulatory burdens. So This will use valuable company time and costly resources, and we see this on Main Street with the regulations that Biden administration has put on businesses. So we'll see it in costly resources that business owners could otherwise be using towards raising capital, growing business operations, quite frankly, hiring people and put people to work. So can you discuss the impact that increased reporting requirements and the associated costs will have on attractiveness of our public markets and private companies' decision to go public and grow?
While he's answering, we'll just look at the charts because right now it's not really exciting happening right now.
Already are making significant disclosures about climate risk. And I think that what we can do is help bring some consistency, also ensure for those companies that are public that consistency helps them against some that might be making bold claims, what one might call it greenwashing and the like, and help them tell their stories in a consistent way. And as the representative said earlier, Europe also is requiring things, so it will help us be recognized by Europe, hopefully
markets are going to lunch.
That our rules would be recognized by them,
So we'll probably have a little bit of
their
small volatility right
more
now
restrictive rules.
Yeah. All this coupled with interest and regulations
So then we
killing
got this
Main Street American small businesses.
testimony.
Now, by calling on my last
which,
question,
again,
by
in the
calling
beginning
on more
was
stringent
really,
ESG
really fun.
regime, we are
A
trying
lot
to
of
turn the
grilling
many
going
economists
on.
and financial experts
So right now we're
at the
switching over to
SEC
climate
into environmental
questions more than
scientists
anything.
who will force companies to adhere to a moving target of climate change goals coming from whichever party controls the White House. As the materiality standard definition continues to be threatened by your agency, I'm concerned that everyday investors will ultimately be hurt by activists who might be the loudest in the room but are not personally invested in many of these companies. So, Chairman, how will you ensure that investors are not going to be pressured and harmed because of activists pushing their agenda into a space where they do not care about any individual security? Can you commit to materiality limitations?
Materiality is a bedrock of our disclosure regimes, and that's in the context of what basically, as the court says, a reasonable investor would find significant in making their investment decisions.
Okay, I yield my time back. Thank you.
Gentleman from Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you, Madam Chair. Well, first off, I just want to thank you for your work, and I do believe that there should be a rough proportionality between the number of rulemakings and the number of good ideas, and there's a backlog of good ideas, and many of which you're really following through. I am worried about sort of the overload, both on your staff and on industry participants on this. I think, for example, the economic analysis, when you have multiple rulemakings coming in at once and trying to understand how they'll talk to each other and interact with each other is a complicated thing. And I see a huge merit in pilot programs, particularly as regards to market structures on this. That if you just hived off 10% of the markets and tried your new auctions on those, for example, and see if what to me is the bottom line is the quality of order execution for retail traders. That's pretty close to my economic bottom line. And I'd also like to commend you on your approach to 605 in terms of it needs to be updated. And providing retail investors some idea of what kind of quality of order execution they get when they switch to different platforms, I think is the right answer. But I'm a little bit leery about having a new complicated reporting requirement for all the different market participants. There is one entity that has all the necessary data. It's the consolidated audit trail. And running some standard agreed upon open source version of the software on the consolidated audit trail, some lagged version of the consolidated audit trail, I think would get that information in a form that would be digestible. So if you could, I could just have your reaction first off to pilot programs and secondly to the technical implementation of measures of execution of order quality.
We're in the mid-100s, 3100s.
We put out the 4 proposals in December, and I think that they address separate important parts of the market. In terms of the 2 that you mentioned, the updating of a 23-year-old rule so that the retail public, the individual investors can get better information on execution quality, I think is what you call it, 605. I'm glad to hear you're supportive of that. In terms of the auctions that we proposed, this order routing rule that we proposed, that was really to help individual investors get better execution and get more competition with regard to their execution.
Yeah, but it's not blindingly obvious, at least to me, that they're actually going to get better pricing. You know, this sort of cockamamie system that we have right now does allow a retail investor to sort of raise up his hand and say, look, I'm clueless. Will you give me a good price to trade against me because I'm documented to be clueless, if you understand? They have low toxicity of their order flow is, I think, the buzzword.
I like to think that the individual investor is pretty smart, but the individual investor is only trading small amounts of stock, and so there's a sweetness in the order, and it's trying to get competition for that sweet order because it's small.
Yeah, but right now, your system, as I understand it, might take away his ability to sort of monetize the sweetness of his small, clueless orders.
I actually think, and again, it's only a proposal. We're going to consider all the comments that come in, but it's trying to get even greater competition. It's saying that order could go straight to a lit exchange. That'd be fine. That order, if it can get at least mid-market, half the spread, that would be fine. But if it's less than that and not on a lit market, put it out to some competition.
Again, we're getting to the second half.
And then so a pilot program would reveal that. Is the main point I'm making, that if you do this, you should see better, hive off 10% of the market, try your auctions, and see if the order execution quality is better. It seems straightforward. I'm a scientist and a big fan of data. Nothing is more joyful as a scientist than to prove the theorists wrong. And you have theoretical calculations that should save money, and you should be able to prove it with a pilot program before you expose the whole market to it. Let's see,
Please yield your time.
Touched on crypto. And one of the lessons, it seems like if you're going to prevent wash trades, you need to know the true identity. Some regulator somewhere has to know the true identities behind market
for traders.
And have you found any way in the crypto business to reconcile sort of the crypto libertarian point of view with the absolute necessity to know the true identities to prevent wash trades, or are wash trades the price we pay for crypto?
It's to get the intermediaries, the storefronts, to register, and then we could get the data from those crypto exchanges themselves as to where the buy and sell orders are coming from.
Gentleman's time's expired. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you. Chair Gensler, I have a lot of questions in a limited amount of time, so if you could keep your answers to either a yes or a no, that will allow us to get through as many as possible, sir. From your perspective, is it more difficult now for the digital asset industry to access financial products and services in the United States than it was, say, 2 years ago?
Yes or no?
Sir, I'm not running one of those businesses. If they came into compliance, I think
reclaiming my time. The answer, sir, is yes. Do you think you and the SEC have had a role to play in that?
I think we have a role to protect the American investor and the capital markets. And
reclaiming my time, sir. You have played an obvious role in that. During your tenure at the SEC, how many rules has the SEC finalized that actually accommodate the existing regulatory framework and are specifically to the digital asset industry so the crypto market can come into compliance?
It's our rule books that are on the books for years, so we have not finalized any new rule specifically with regard to crypto. We've proposed some things in best execution. We've also...
Sir, reclaiming my time, the answer is 0. And how many enforcement actions has the SEC levied against digital asset companies during your tenure, sir?
Killing them.
I think it's probably 40 or 50.
The answer, sir, is about 55. My understanding is that the biggest crypto failure in history is probably FTX at $9 billion. Were you the chairman of the SEC when FTX collapsed?
Yes.
And how many times did you meet with FTX prior to their collapse?
Ooh.
I think my public record shows 2.
You met it with FTX at least twice. And arguably, the second biggest crypto failure in history was Terra Luna. Who was the chairman of the SEC when Terra Luna collapsed, sir?
We had brought...
You were, sir. Reclaiming my time, you were. There are 5 members on the commission. Do you believe your speeches and interviews are to serve as the official position of the SEC?
I can only speak for myself when I'm speaking.
Again, sir, in a statement on the SEC website, you are quoted saying, the Kraken staking as a service enforcement action should make clear to the marketplace that staking as a service providers must register. But again, you haven't provided any rules for how that can be done.
Yep.
I must remind you, your public statements are not regulations. It's not responsible to expect the American people to assume your statements are a substitute for rules.
Wow.
Do you agree with this statement regarding the digital asset industry? The SEC needs additional congressional authorities to prevent transactions, products, and platforms from falling between the regulatory cracks.
I think that it's a largely non-compliant field. And
Sir,
we could use
again,
additional
I asked you to comply with my questions, and I'm asking you if you agree with that quote. And I'm going to tell you, I'm quoting you from an August 3rd, 2021 article where you, and I believe you told Congressman Hill earlier that you need congressional authority to regulate stablecoins, and stablecoins happen to be a significant percentage of the crypto market. So the question is, when were you telling the truth? To Mr. Hill or to me? You've got to start answering these questions in a more transparent manner, sir. Does it concern you, by the way, that your approach to the digital asset industry is actually driving this industry out of the United States?
We're trying to drive it to compliance, and if they're not complying with the laws, then they shouldn't be offering their products.
Reclaiming my time. Madam Chair, I would like to enter into the record this Wall Street Journal article from April 14th, 2023, detailing China's ploy to open its banking system to crypto firms in an effort to seize an opportunity created by our hostile regulatory environment, which, Mr. Chair, you're a big part of.
Mr. Emmer,
Chair Gensler, FTX
Good
was domiciled
times,
abroad,
good
and so is
times.
Binance. Yet American consumers still had access to both. You can't really think that pushing this industry abroad is going to protect American consumers when it hasn't several times in the past on your watch. You say the crypto market is rife with non-compliance. However, existing SEC rules make no sense for blockchain-based companies, and following them would actually kill these businesses. Your regulatory style lacks flexibility and nuance, and as a result, you've been an incompetent cop on the beat, doing nothing to protect everyday Americans and pushing American firms into the hands of the CCP. Your intention to work against SEC mission and put American investors in harm's way has been made very apparent, sir. It's been a year and a half since you've appeared before this committee. You need to answer to Congress about the issues that you've had with the SEC staff union, the work environment you've cultivated at the SEC that's led to hemorrhaging of senior staff, the intellectual inconsistency of your regulatory treatment towards Bitcoin spot ETFs, and your politicization of capital formation opportunities through your treatment of certain SPACs.
Yes.
And that's just to name a few. Thank you. I yield.
Gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Ranking Member Waters. Mr. Gensler, thank you for being here today, and thank you for your leadership on many fronts. I'll try to take a breath here, but I have a couple quick questions. I've shared with you my concern with the unusually short-fused, overlapping, rushed, and zone flooding rulemaking under the SEC, and undermining my fear that it undermines the public's ability to provide thoughtful feedback on the proposals of the Commission and risk stressing an already tenuous economic climate. The SEC's Inspector General raised concerns with this aggressive and rushed approach to rulemaking in a report last October, and raised concerns the SEC has staffing issues that may affect the quality of the rulemaking given these short fuses. Some of these proposals are necessary, obviously, to protect investors, and I want to make sure they see their way through and to ensure stability in the financial markets. But I'm concerned that doing it in this manner, it's sometimes hard to tell the impact these rules will have collectively on the economy, on jobs, on certain key job-producing sectors in my state of Jersey and the tri-state area and nationwide. Since you've taken the helm of the SEC, 27 of the Commission's 53 comment periods have had a highly unusual comment periods, shorter than 45 days from the date the proposal was published in the Federal Register. Considering the delay between when rules are posted on the website and when they are posted in the Federal Register as part of the comment period is not only consistent, it strays from the historical practices of the SEC. These proposals collectively total more than 4,000 pages with more than 2,500 questions to respond to. Last year it took a letter from 47 members of Congress to get you to extend a 30-day comment period on a 300-page rulemaking with more than 900 questions. Many of the proposals put forward by the Commission in the last 2 years affect the same stakeholders who've repeatedly requested additional time, especially small businesses and other smaller players in the space, to respond to the SEC's often overlapping and rushed comment periods. And I'm concerned that limited stakeholder engagement, especially from small businesses without large regulatory teams to respond, will lead to unintended consequences that will ultimately harm American consumers. Have you at any point been concerned that by moving this hastily, that it could really hurt smaller market participants and their time to provide feedback?
I'm very proud of what we've done. We put out 46 proposals to date. We've reopened some, so that may be why this other number is floating around this hearing. And on average, it's been more than 70 days from the time we voted out, we put it on our website, and we have a formal end to a comment period. But then we get comments after that, and we take meetings after that, and we engage actively with trade associations and market participants.
My only concern there is when, it doesn't actually count when it goes on a website because there's no formal comment period on a website. It's the federal when it goes to the Federal Register is what